Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I want to talk about the big news that dropped a couple weeks ago on X. You're like, which big news? Lots of big news drops on X these days. It's where everyone goes to get all the big headlines, but I'm talking specifically about Bill Pulte announcing that FHFA, Fannie and Freddie will soon be utilizing the Vantage credit score. And oh boy, this sent the whole mortgage industry into a bit of a panic and also a little bit of excitement. I'll be honest with you. And I'm going to talk about, what's good about this and what are the potential pitfalls and concerns that you might be looking for. But that was kind of out of nowhere, right? I mean, just. Bill Pulte announced we'd be using the Vantage credit score, and everyone's like, well, what does that mean? Like, when do I need to be prepared for this? How are we going to implement this? So many more questions than answers, right? And it's kind of like just poking the hornet's nest. I don't know why they do things like this. It seems to be a theme of the current administration, but hey, nonetheless, it's like, let's start with the big news, and then we'll figure out the details a little bit later. So this was a couple weeks ago. And I guess the first thing I would say is, I personally am excited about this announcement. I think this is a good thing. I'm going to kind of walk through why I feel that way. But secondly, I would say is like, let's all take a deep breath, because I think every mortgage company is already prepared to do what they need to do when the time comes to implement this. But there's a lot that has to happen on the back end before you see a full implementation of this. I mean, we're talking about, there may be changes to how this impacts pricing, right? Like, do these credit scoring models have such a different impact than the current FICO score model that we're using that there needs to be changes to, things that are based on credit score, like the loan level price adjustments. Like, how much is it going to impact loan level price adjustments and the revenue that's generated from those? I could imagine there will be an impact, and there may be modifications to things like that. The mortgage insurance modeling, right? We're a purely risk-based mortgage insurance at this point, and it's all driven by FICO score. Will these credit scores, be different enough that they need to make changes there? So anything that's kind of risk-based within the mortgage space has the potential of being disrupted as a result of this change. But I think that it's important. One thing that's not being talked about is that the Vantage score, it is a different type of scoring model, and it's been around and in development for over 20 years, or right around 20 years. And it's taken a long time for this to become mainstream enough to where it's being considered and now, implemented as a baseline for underwriting mortgages with Fannie and Freddie and all other mortgage products. But there is another similar credit scoring model by our good friends at Fair Isaac. So there is a FICO, what they call FICO 10T. And this is also similar from what I understand. I don't have all the data, but this is more similar to the way that the Vantage score, kind of underwrites the risk of someone's credit profile. And things are, it's more trend data, right? It's more, looking at trends over time. And there's certain things that aren't included, like medical bills and things of that nature that you might see impact a FICO score. But then there's other things that are considered, like utility bills often can be included, rent, things of this nature, which we're not used to seeing in the standard FICO scoring that we use today. So I think it's a little bit of a misconception to think that you're either going to have Vantage score or you're going to have your traditional tri-merge, FICO scores that we use today. Fannie and Freddie did come out with a little bit of a FAQ, and one of the things they said is they'll still be requiring a tri-merge or a bi-merge credit report. And as I think about this, I don't think blending the current, credit scores that we get from Experian, TransUnion, and Equifax with a Vantage score is going to work. So I think when we think of using the Vantage score, I expect to see a bi-merge report that is a combination of the new FICO 10T and the VantageScore and utilizing a bi-merge credit reporting for underwriting of these loans, or the traditional tri-merge, assuming they continue to allow that as it exists today, which I think, at least for a period of time, would be the case. But blending the old model with one of these new models like the FICO 10T or the Vantage, probably not what's going to happen, at least in my opinion, in the research I've done so far. And I'll add a caveat to that, which is there's not a lot of data or clarity around any of this at this point. So just don't forget about FICO 10T. I don't think Fair Isaac and the FICO system's completely, out of this for now. But what this does do is it brings competition, and that's a very good thing. If you're at all involved in, working with the pricing for credit reports over the last couple of years, then you know that credit score costs have gone up significantly. Now, we cannot blame all of this on FICO, but they have raised their fees significantly. And it ranges so widely based on, if your company is getting their credit reports from a certain data aggregator, right? What do they charge for the services that they provide? I mean, this is multiple layers deep, and I'm not going to go into all of that, but it does all start with the base price of obtaining that FICO score, and that cost has increased significantly, as well as the cost and the premiums that have been added by Experian and TransUnion and Equifax, on top of the fees that have been increased by the data aggregators that we all get our credit reports from. So this is a multi-layered issue, but it does start with FICO at the bottom of that food chain, and their prices having increased significantly, and there's zero competition. I mean, let's admit, they have a complete monopoly right now on the credit scoring model. So the Vantage credit score coming into play definitely brings an element of competition that we have not seen. And you know me, I love fair market, free markets. I love competition, and competition breeds innovation, but it also breeds competition and can drive prices back down. So that is a huge positive of this. Let's talk about maybe some of the other positives and really the reasons why this is something that Bill Pulte was so excited to announce, I would argue a little prematurely, on X. But look, the goal here, you guys, is to broaden access to credit, right? We want more people to be able to buy houses, and we want a credit scoring model that is maybe different than what's been used for the last 30 years and is a more modern way of looking at credit risk. And, one of the things they talk about, the VantageScore and the data over time. Like, I'll give you one example. Like, let's say that someone utilizes their credit card for all their purchases. Maybe they get airline miles or, whatever the case may be. They like to use their credit card. And there are a lot of benefits to using a credit card. You can dispute charges that are, erroneous, or if you get taken advantage of, or, there's lots of reasons why you might not want to carry cash with you, so on and so forth. So using a credit card is not in and of itself representative of someone who is relying on that debt to cover their day-to-day expenses. But because of the way that a credit score is done, we're just taking a snapshot. So if you have a very low limit on your credit card, but you happen to have a lot of expenses in a short window of time, and you put those on your credit card, and then boom, we take a snapshot of your credit profile, and you're close to your limit, you could lose 80, 100 points in your FICO score because of that. But what if you pay off your balance every single month? I mean, shouldn't that be taken into consideration? And it doesn't do that because it's just a snapshot of your current situation. So when I think about considering trending data over time, that's one example that comes to mind of how we might have a little different way of scoring someone instead of just looking at their current balance to their available limit. Like, how are they using that credit card over time? To me, that's a huge factor, and I think a perfect example of the types of things that we should be looking at differently when it comes to analyzing someone's ability or not ability, but their likelihood, to repay their debt. So back to my list. So access to credit. Look, the goal here is to give access to credit to more people that are deserving. Look, a lot of people have very, very thin credit profiles, right? They just don't use credit a lot. They're the opposite of the person who uses their credit card for every purchase. So for those people, when you start adding in utility bills, for example, or rent, things of that nature, we used to call that like building alternative credit. But if that's already built into the model, it's going to help a lot more people have a functioning credit score with a kind of a thick enough profile to be able to extend credit to them. So I think this broadens access to credit for more people. It introduces kind of new and different scoring methodology, like what I talked about. It also does mean, though, for our industry, operational and underwriting changes. And this could be pretty significant. I think we don't know what's going to happen here, but I think we need to expect that if we start using credit scoring models that look at data differently, it would only make sense to me that we might interpret our underwriting guidelines in a little bit different ways to be supportive of that new scoring methodology. So don't be surprised to see some credit policy changes and underwriting changes as we go through this. I already talked about the fact that this is going to drive market competition, which I think is great, and the possible impact to all things that are loan level price adjustment or risk-based pricing within our industry could be impacted by this, and may even need to be completely rethought of, right? They might need to remodel some of the loan level price adjustment grids, et cetera. So all that's going to take time. When is this going to happen? I think that you could see a pretty quick adoption at some level of utilizing the Vantage credit score in the mortgage process, probably here in 2025. But I expect that we have a much longer time horizon until we see the full implementation of all the things that I just mentioned here, and to where you're seeing this utilized in the mature form that they are imagining. I'm thinking probably late 2026. It could take all of 2026 for this to happen. But I wouldn't be surprised if some people are able to start supporting, pulling of a VantageScore. I wouldn't be surprised if Fannie and Freddie can make some quick updates to the AUS to be able to consider that. But I don't think it'll be fully integrated into their algorithm, and we're getting the full benefits, let's say, of this new scoring model for quite some time. It may feel like we're using this new scoring model, but I don't think the full changes to how we view risk and extend credit will be implemented for probably, 18 months, 12 to 18 months would be my guess. We'll just have to see how that unfolds. But bottom line is that this is exciting because this is the first type of any sort of innovation or change really that I've seen in 30 years in the mortgage industry since the implementation of automated underwriting, and look at the impact that had. So this to me is a very exciting time. We're potentially going to get people into houses that otherwise would not have access because of the scoring model does not benefit how they run their lifestyle. This is going to modernize, how we look at credit and risk. I think that's happening as an industry, as I think about all the non-QM and all the other things that you're seeing today. So a modernization of credit and risk. It's going to increase transparency and competition within the credit scoring models. So all that, in my opinion, is good news. Look, more to come on this, but keep an eye on this because it will be changing. It will be impacting borrowers, and you're going to start hearing about this from your clients. So you need to know. You need to know enough to speak intelligently about what's the difference between a Vantage credit score and a FICO score. As these timelines start happening, when will this be available for people to use? And what'll be the differences? What are the kind of classification of a borrower that might not qualify today, that could qualify in the future? I think we all need to educate ourselves a little bit more on what this actually means. We'll do our part here at Market Shares to keep you up to date on anything that I hear regarding these changes and implementation and what it means. But continue to do your own research. I think all of us are better when we take on a student mentality. We should always be learning, always be growing in this industry, because it makes you that much more bulletproof from, the AI world, the automation that we see in our industry. When you can bring knowledge to your clients, that is a differentiator. And all of us should be working hard to raise our level of knowledge around these things. So I hope that was helpful and interesting. Look, please share this information, share Market Shares with people that you know in the mortgage industry. I would sure appreciate it. And until next week, when this comes out, right? Every Friday at 10 a.m. Pacific time. We will see you then. And until then, take care. Bye for now.